ETFs are a great tool to get safe and consistent passive income without having to choose and own individual stocks. But their rise in popularity means there's a lot of choice out there. So which ones are the best for us passive income investors? What's up guys, my name's Adrian and welcome to my channel on passive income investing. In my previous ETF video, I explained what an ETF is in detail and how they work, as well as the different types of ETFs out there. In this video on ETFs, I will share with you a list of about 30 ETFs that are listed on the Canadian stock market, or the TSX. It's important to note, however, that just because they're listed on the TSX, it doesn't mean you're only investing in Canadian companies. It only means that the funds are listed on the TSX and easily accessible to Canadians since you buy them with Canadian dollars. So by using a combination of these ETFs, you can easily build a fully diversified portfolio that will generate passive income for you and your family for life. It took me about 2 years to hunt all these ETFs down, learn how they work and what sector and region they each cover. And I put it all together in a nice little spreadsheet for you. So you can download the spreadsheet for free and follow along. Just click on the download link in the video description below. So let's get started with the list. All right guys, so here's the spreadsheet. We'll start with the BMO ETFs first. So I'll just explain how I formulated the spreadsheet. So first column here, you have the ETF manager. This is simply the name of the ETF. Covered call strategy, yes or no, if it uses it or not. The TSX symbol, the annual management fee of each ETF. Keep in mind that you won't be seeing that fee. It's not like you're going to be paying it out of your own pocket. It's included in the fund itself. The dividend payout, so if it's monthly or quarterly, which is every 3 months. The annual dividend yield. So an important note to talk about for ETF annual dividend yields. They're a bit tricky to calculate because they sometimes vary month to month. So these annual dividend yields are basically the average of the last 12 months of the fund, which is usually the typical way that that any website will display the annual dividend yield. And of course this year I took as of the prices on June the 9th. So the sector is basically what sector this covers, the fund covers. So if it's mixed, it will have mixed. If it's a specific sector, it will have the specific sector. What region it covers, as well as just a little some further details on the fund, and more details on exactly what's included, what kind of stocks are included in the fund. Let's get started with the BMO ETFs first. I really like BMO ETFs. In my opinion, they have the best region-based ETFs. So the first three are very similar. I've talked about them in other videos as well. So they focus on dividend stocks in Canada, dividend stocks in Europe, and dividend stocks in the US. So each of them have 35 blue chip dividend paying stocks. Really generous yields. As you can see here, they give the yield monthly. All three of them use a covered call strategy and have the same management fee of 0.65%. So a really good way to get broad exposure to Canada with this one, a broad exposure to Europe with the second one, and broad exposure to US with the third one. The fourth one here, US put right, gives you some added exposure to US if you want. It's a really interesting ETF. Basically, it's comprised of 44% of the ETF is the SPY ETF. So if you don't know what the SPY ETF is, it's pretty much one of the most popular ETFs on the market, which tracks the S&P 500 index. So it's a good way to get overall exposure to the US market. So that's 44% of it. 33% is government bonds. And then you're also getting some options income in the form of put options income. So very similar to the covered call strategy, except this is a put option strategy. And as you could see here, the annual dividend is really generous. So really interesting ETF if you're looking for added US exposure. These two are pretty much very similar and complement each other nicely, if you ask me. The next one is an index ETF with a twist. So it's the covered call Dow Jones Industrial Average ETF. It uses the covered call strategy, and like the name says, it follows the Dow Jones index, which is the biggest 30 companies by market cap in the US. So the dividend yield is not bad. It's a bit lower than the other ones. It's normal because you're dealing with really the biggest 30 companies, very, very powerful, very safe. And you are getting a pretty good yield though, considering, because they use the covered call strategy. So I really like that one. If you like index ETFs, this is a really good alternative. The next one is similar to the first three, except it's global. It covers all regions in Canada, Europe, and the US. And instead of having 35 companies, it has 50 companies, blue chip companies. So it's a little bit safer because it's more diversified than the first three. If you're looking for something a bit more stable, the dividend yield, like as you can see, is a bit lower than the first three, but it's still pretty good nonetheless. The next two focuses on preferred shares. So the first one is the ladder preferred share index. This focuses on preferred shares in Canada. And then you have the US preferred share index with ETFs, which focuses on preferred shares in the US. So if you don't know what preferred shares are, they're basically, they're actually considered fixed income, kind of like bonds. They're just a safer version of a regular stock. So they have, they call them preferred because you have preferential treatment in terms of dividends, or if something goes wrong, these shares are a little bit more protected. That's why the dividend yields are a bit lower, but they are safer. So this one here, covered call utilities, like the name says, will give you exposure to the very safe and stable and defensive utilities and telecommunication sector in North America. So it has both Canada and the US, which I really like. It has about 24 companies. The next two here are the banks. So you have the covered call Canadian banks, covered call US banks. Pretty much these two perform the same function. They give you exposure to the big Canadian 6 banks, which are really safe. They're well known, and the big US banks. There's about 14 banks, if I'm not mistaken, in this ETF. So a really good alternative to own. Instead of owning the individual banks, you could own these ETFs, and they're a lot safer because you have all of them, and you're also getting a nice yield because they use the covered call strategy. The next one, the high yield US corporate bonds, is like the name says, gives you exposure to US corporate bonds. The dividend yield is actually pretty good, if you ask me, because bonds usually don't give that much of a dividend, but well worth it in my opinion if you're looking for some safer income coming from the US. Bonds are considered a fixed income like preferred shares, so they're a little bit safer than stocks. So it's a good way to get a little bit of safe exposure here. This one here, the monthly income ETF. So this is a pretty cool ETF because it has a mix of a bunch of different BMO ETFs all put together. So the breakdown is actually 57% stocks, 43% bonds. So really conservative and safe. My opinion, I would say that this one could actually be used like a savings account. It's much better getting 4.77 instead of less than 1% in like a regular bank savings account. You're basically getting a little bit more yield, or a lot more yield I should say, and the risk is fairly low because of the good diversification that you're getting here. And the last three from BMO are the index ETFs. So the first two concentrate on the US. So the first one is the Dow Jones Industrial Average Index, so the biggest 30 companies in the US. And the S&P 500 is another popular index for the US. It's the biggest 500 companies in the US. So these two are really, if you want to invest broadly in the US stock market. As you can see though from the annual dividend yield, they're a lot lower. The reason is because these ETFs include dividend and non-dividend paying stocks, so that's why the dividend yields are very low. But the advantage of these guys here is that the management fees are extremely low as well. And the last but not least, this is the index ETF that covers the Canadian stock market, so a little bit higher, and this covers basically the broad-based entire Canadian stock market. All right, moving on to the other ETFs now. CI First Asset have a really good couple of sector ETFs. The first one is Energy Giants Covered Call, so a really good one if you want exposure to energy, the oil and gas sector. The interesting thing about this ETF is that it has no Canadian exposure whatsoever. So if you want to invest in energy but don't want any Canadian exposure, this is the ETF for you. The next one, US and Canada Life Co Income, is really interesting. It focuses on the biggest life cos in North America, or the life insurance companies. So it's a really good way to diversify your financial exposure. Instead of putting your money into the banks, life insurance companies are a little bit safer. So you have the breakdown here: 70% US, 30% Canada. So from Canada, you have the three biggest ones, which is Manulife, Sun Life, and Great West Lifeco. The Gold Plus Giants Covered Call focuses on 15 really big gold producers, a good way to get exposure to gold. And the Tech Giants Covered Call focuses on the technology sector. So you have 25 really big technology companies. All right, moving on to the Harvest ETFs. They have really good sector specific ETFs, and a good thing I really like about them is they give all their dividend monthly. So Energy Leaders Plus Income focuses on the energy sector, a really high dividend yield right now because energy took a really big hit during the coronavirus, and it's still pretty much down. So you have about 20 energy giants here. You have a breakdown. So you do have some in Canada opposed to the NXF ETF here, so a really good balance in terms of region diversification. Healthcare Leaders Income focuses on healthcare stocks, so you have 20 blue chip healthcare companies, and most of them are going to be in the US. So a really good way for us Canadians to get access to this really lucrative market, the healthcare market. Brand Leaders Plus Income is really interesting. It focuses on companies that have huge brand power, companies like Apple, Nike, Visa, etc., etc. So a good way to get extra US exposure here, and a fairly safe exposure as well, because those companies are extremely safe and valuable. Global REIT Leaders is a good way to get exposure to real estate, especially non-Canadian and non-Canadian. So you have the breakdown here: 54% US, 32% European. So a good way to get exposure to the global real estate market. Tech Achievers Growth is very similar to the TXF ETF from CI First Asset. The only difference is that they give their dividend monthly. It focuses on 20 big tech companies. And last, from Harvest, you have the Equal Weight Global Utilities Income ETF, which focuses on utilities and telecom, so very safe and defensive sector, and it has global exposure. So there's 30 companies in there. Sorry, and you have the breakdown here: 30% US, 20% Canada, the rest international. So a really good region diversification here in terms of utilities. All right, moving on to the Horizons ETF. So the first one is the Marijuana Life Sciences Index ETF. This is the best way to get in on the cannabis industry because it's a index ETF. So you'll have really good equal and broad exposure to the sector as a whole. If you're interested in investing in cannabis, check out my other two videos. I made two videos specifically on cannabis investing, and the second one really goes into detail about this really good ETF. The Enhanced Income Financials is a good way to get diverse exposure to Canada financials. So it has only Canadian businesses that deal with the financial sector. So you have the banks, you have the life insurance companies, and you have some wealth managers as well. The next one, the China High Dividend Yield Index, is a really good one. It's the only ETF I found that really gives you good exposure to Chinese stocks, specifically dividend stocks in China, with a really decent yield here of 6.5%. So a really good way to invest in China. Enhanced Income International Equity is probably one of my favorite ETFs to invest in international sector. So this ETF has no Canadian or US exposure whatsoever. So you're only investing in international blue chip stocks. So really excellent way of getting that international exposure. across all sectors. It has mixed sectors. The next two are covering gold. So enhanced income gold producers have really big gold producers in this ETF. So very similar to the CGXF ETF here from CI First Asset, except you're getting the dividend monthly. That's basically the main difference. The gold yield ETF, so this is if you want to invest in gold, but you don't want any exposure to the actual gold producer. So this is pure exposure to gold. This ETF is actually backed by physical gold. So if you want to invest in gold, but you want nothing to do with the gold producers or the miners, this is the ETF for you. And last but not least, the REIT Index Plus ETF from Middlefield is a really good, one of my favorite real estate or REIT ETFs. So this one here gives a monthly dividend, uses a combination of index and active management. That's why it's called Index Plus. So you have the breakdown here: 62% Canada, 35% US. So yes, really heavily on the North American side. Opposed to the other one here from Harvest, which has no Canadian real estate exposure, a little bit more US and Europe. So this one, what I really like about it is it has a collection of REITs that focuses on especially residential and industrial, so safer real estate. So a really good way to get access to real estate here. So there you have it, guys. Those are, in my opinion, the best ETFs on the TSX right now, which cover every region and every sector. By using a combination of these ETFs, you can easily build a fully diversified portfolio that is tailored to your specific needs. So you might have noticed that most of the ETFs use a covered call strategy. If you want to know exactly what is this strategy and how it works in detail, check out my other video where I discuss just that. So also note that the stock symbols in the spreadsheet are all hyperlinked. So if you click on any of them, you will be directed to the ETF's homepage in case you want to read up further yourself, which I strongly suggest that you do. So if you're a new investor and want to build a stock portfolio using only or exclusively ETFs, I think it's a very smart idea. But how do you get started? How do you decide which ones to actually invest in? And more importantly, how much money do you allocate to each ETF? The honest answer is it depends. It depends on your age, on your circumstances, and your investing goals. Somebody who's 65 years old and retired should not have the same stock portfolio as a 30-year-old in the prime of their career. So the most common question I always get is, how do I get started? What should I invest in first? It's completely normal. Many people are scared of pulling the trigger and making their first move, especially if they had somebody else manage their money for them, like a bank or an asset management company. Don't worry, I got you covered as usual. In my next ETF video, I will show you 5 sample portfolios to inspire you. Each portfolio will tailor to different investment needs, but here's a little preview for you. Portfolio sample number 1 will be for conservative investors that focuses on safety. Portfolio number 2 is for balanced investors, which focuses on diversification and stability. Portfolio sample number 3 is for income investors, which focuses on maximizing passive income. The possibilities, guys, they're pretty much endless. It's literally like choosing toppings on a pizza. Everyone is different and has different investing needs. It's ultimately up to you to choose the combination that best suits your needs. So make sure to check out that video so you can get inspired and start building your own portfolio. Remember that the best thing money can buy is not the newest iPhone or a brand new Lexus, it's passive income. Once you have enough passive income to become financially independent, then you will be happy, very happy. So thanks for watching, guys. I really appreciate it. Please hit the like button if you learned something, and take care. See you next time.